volatility is the common theme when you invest. I think it's more useful for investors to think about risk-adjusted return when evaluating any investment.
So back to what I was saying. Could be us.
So one of the key themes for the market this year would be volatility. For many investors, including myself, what I've actually observed is that while we have seen the global markets reaching new record highs, it has actually come with increased price movements, and that actually affects many investors in terms of their mindset and how they manage their portfolios. So to help us understand this topic better, I'm very pleased to have with me today Karen Lim, Managing Director, Retail Sales Head for Southeast Asia at AllianceBernstein. Karen, thanks so much for joining us today.
Gerald, thank you so much for inviting AllianceBernstein.
What we wanted to really dive into today is this topic of volatility. And I think when I was doing my research, I realized that you've been in the industry for 25 years,
Yeah.
probably
Oh, no.
not a stranger to volatility in the markets.
Yeah, absolutely. Yeah. Well, obviously, I think volatility is the common theme when you invest. But I really think that investors should not, because of this negative headline, because of the volatility in the marketplace, keep them out of capital markets, right?
For investors who might not be familiar with AllianceBernstein, can you maybe give us a bit of background around what you do there?
Right, sure. So I'm responsible for the intermediary distribution and bring AB AllianceBernstein research as well as our investment solutions to client. We're very blessed to have been in this market for 30 years now, and I've been 25 years at AllianceBernstein Singapore. We do have a few flagship solutions that some of the investors might be familiar with. And one of the popular one is AB Low Volatility Equity Portfolio.
So I think if I look at one of the key developments this year is really this uncertainty in the markets.
Yeah.
We have seen uncertainty in terms of the direction of interest rates, uncertainty towards tariffs. So how do we think about the kind of investing environment that we are in now?
I think it's very, very hard to accurately predict what the market's going to do, right? If we think about just last April this year, wow, there has been a sharp sell-off and this eventual recovery. And honestly, if you close your eyes for the entire month of April, you don't even know what has happened, right? But that would actually also deter a lot of investors to stay away from capital markets and miss the opportunity to enjoy the eventual recovery. So while we do not have crystal ball to really predict what the market would do, but what we try to do, for instance, in the case of our low volatility equity, is to then try to build a resilient portfolio that could weather different market scenario and try to avoid companies that might be vulnerable to trade war, to tariff, to valuation risk or political uncertainty.
So I think you brought up a very interesting point around the volatility in the markets and how investors can adapt to them.
Yeah.
So I remember doing one of our podcasts earlier this year talking about the tariffs and how that actually led to a very sharp correction in the markets in April. We are now at the second half of 2025 and we've seen markets recovering fairly strongly. So I think against this backdrop, how should we understand what is volatility and how investors should understand this term in the context of their portfolios?
Well, I guess in layman term, right, volatility is a measure of risk. It's a measure of a price movement, of a stock or of a market. And obviously, when the price movement is big, it tends to represent greater volatility. If the price movement or price swing or price fluctuation is smaller, then it seems to suggest it's more stable, less, volatile. But I think a useful concept to think about or to introduce investors, right, is this risk-adjusted return, right, where the investment return is evaluated in relation to that volatility or the risk in order to get that return. I think it's more useful for investors to think about, risk-adjusted return when evaluating any investment. So for instance, we aim for a 90% and 70% upside and downside capture. So let me explain. So when market goes up, say by 10%, we aim or we strive to at least, right, go up by 9%. So that's a 90% upside capture. Similarly, market goes down by 10%, we hope to only fall by 7%. And we believe that by having this 90-70 upside downside capture, we're able to beat the market over time with lesser risk, right? And if you looked at our risk adjusted return, we are able to deliver that return. So I think risk adjusted return might be a more useful concept to consider.
Yeah, so thanks so much for introducing us to that term, because speaking to many of our readers, often the comparison is around what's the dividend yield you're able to
Yes.
get on the fund, what is the historical return on the fund.
Yeah.
But I think this concept around risk-adjusted return is
Yeah.
actually less talked about.
Yeah, I think there's nothing wrong with volatility,
Mm.
right? If I have to steal a Chinese word, there's this word wei ji, where crisis presents opportunity, which volatility can create opportunity as well. But I think it's how do you then manage that volatility? I think it's an important one. Yeah.
I think what I've observed from many of our readers is many actually struggle to manage this volatility themselves.
Yes.
Like because they might not have the tools to be able to manage them, maybe having mindsets that prevent them from achieving the kind of returns that they want to be getting. So what can we actually think about in terms of solutions that can then better help them to manage this volatility?
I want to bring up this concept of loss aversion, right, which is used widely in behavioral finance. I feel when the market goes up or the market is strong when we're in a bull market, investors don't seem to mind the risk or doesn't mind the volatility because they can ride with that wave, right? But, usually when market is bearish or when market, is very volatile, all of a sudden, right, they want to bail out from capital markets. They want to just hold cash. And I think, a lot of investors like to think that they are risk averse, means they don't like the volatility. But actually, the truth is they are loss averse because, in behavioral finance, the pain of losing money is actually 2 to 3 times more painful than making the same amount of money. So I think we have to be aware that there's a lot of emotions attached, right, to this volatility that they have in their head. I think the best way is really to have a long-term goal, to have a long-term plan and stick with it. Now, technically, economic cycle or how the market is doing shouldn't derail you from that long-term plan to your long-term goal. So I think it's about how do you think about volatility?
So for investors who may not know the difference between risk averse and loss averse, how can we better understand these two different concepts?
Sure, I think a lot of investors think that they are risk averse, but actually the truth is they are loss averse. So what do we mean by that? When market is very hot, right? They all of a sudden they don't mind the risk when they will tell you at the start that I'm very, very conservative because they all want to chase for the best performing or the flavor of the month, right? So that is the idea of I think I'm very conservative, but because market is strong, I'm actually okay. Loss aversion is when it's actually a concept that's used in behavioral finance that people actually don't like losing money. The reason why they don't like that because it's 2 to 3 times more painful of losing that $1 as opposed to the joy of gaining that $1. But because of these emotions that it creates inside, people think that, they are risk averse when actually the truth is they are loss averse because of this huge pain associated with losing money. So we play games with investors sometimes at events, just trying to differentiate between risk averse and loss averse, right? The game would show that they don't mind taking risks when the payout seems to be very, very good. But when, suddenly when market is not doing well, they turn to become very, very conservative, not because they are averse to risk, but it's because they're very averse to losing any money.
So if I am trying to understand whether I'm risk averse or loss averse, what can I actually do to understand which market do I fall within?
Wow, interesting question. I don't think you are risk averse. Well, I feel it's always good to take some risk when you're young and obviously saving for that long-term goal. I think it's, like I said, right, there were always things that go up, things that go down, but I think take the risk within what you think you could tolerate, right? I think the whole idea is don't chase for this, high risk momentum, hot flavor of the month type, because when it goes up fast, it can come down really quickly too. I think the whole idea to counter that emotional aspect is really try to be prudent, be balanced, and make sure that you have your eggs spread in many baskets. Yeah.
So to put it in another way, we are probably loss averse in some way or another.
Yeah.
But what we can potentially do is to be risk aware,
Yes.
understand what is the level of risk that we are able to take, what is the level of risk that we are able to stomach,
Yeah.
and then from there think about the solutions that then fit within our risk appetite.
Totally. Yeah. Like I said, I think most people think that they're risk averse. They are not, right? They are actually loss averse. Yeah.
Having been through a number of market cycles, starting from the Asian financial crisis to the global financial crisis, what are some of the key observations that you have had around how investors have been managing this volatility? Do you see any changes in how they're responding to some of these market shifts?
Well, so Gerald, you mentioned that I have been around for 25 years. So when I first started in year 2000, it was the dot-com era, right? And I mean, at that time, the industry is still pretty young, right? And diversification at that point is buying 5 technology or internet stocks, but they're dressed in kind of like different clothes, but same idea. And obviously, we know what happened. The internet bubble burst, and a lot of investors lost a lot of money because that's all they have, right, in their portfolio. And I myself was not too far away from that. I just joined AllianceBernstein, started to make some, earn some income. I used all my savings to actually buy a Singapore-listed tech company, IPO at that time, which was very quickly delisted because the value of the investment fell by some 80-90%. So yeah, I had some painful lesson, and also because I was making my investment decision based on the fear of missing out, right? So obviously, we know how that ended. And then in year 2006, 7, right? It was the global financial crisis that you mentioned. Again, investors were hurt. A lot of their investments lost a lot of money. They were very, very risk averse, and there is this flight to income. But this is also a zero interest rate environment, so fixed income was really the theme. And in fact, income still remains a prominent theme to today. I think AB was very blessed. We were one of the first few managers to bring fixed income funds to the market. At one point, we were dominating market share of 80-90% in Singapore, introducing some of our flagship fixed income. But we also become victims of our own success because everybody then forgotten that we have good equity funds as well. And that really skewed our business. And we were also trying very hard to diversify our business because it was very fixed income centric. And you always know that too much of one thing is always never a good thing. And again, the same thing, right? The idea of diversification is buying like 6-7 fixed income funds, same idea. So we were very intentional. We were very deliberate. We think that we should, baby step, investors into some risk assets, into equity. We thought, hey, a stability equity like the AB low volatility would be a very good one. So in 2017, we brought this out to the market. we faced with countless objections and rejections, right? And in fact, investors would laugh, if I want to buy equities again, why would I want to buy a low volatility equity? Yeah, we persevere, right? Because it was like herding cats, very, very challenging. We did a lot of investors education. We introduced a lot of behavioral finance concept in our investors education. Finally, we got the conviction and buy-in from key distributors who are willing to work with us, who believe in the story of low volatility. Today, globally, the fund now is about 8 billion in size, and investors finally understood the concept of risk-adjusted return. So we were pretty proud, and I think that's one of our proudest moments in like able to make low volatility quite a success here in Singapore.
So for many of our readers, we receive questions about the income funds in the Singapore market, but equity funds is something that less readers actually discuss about. Can you maybe share a bit more about the AB low volatility equity portfolio?
Well, I would love to do that. So we hope to deliver global equity returns with lesser risk. So we strive to, in rising market, give investors that, opportunity to capture the upside. But more importantly, when the market is volatile or risky, we hope to also and have some risk mitigation. We believe that by investing in quality company that are stable and at the right price, you're able to beat the market with lower risk.
In terms of the positioning of the portfolio, is it in US stocks, global stocks? How do you think about the geographical allocation?
Right. So this is a global portfolio investing in countries globally, but we focus on developed market.
So I think you brought a number of concepts earlier,
Yeah.
bringing in the concept of QSP, which I've seen in some of your ads around. Can you explain to us really what does this QSP really mean?
Truly, the essence of low volatility really rides on this quality, stability, and price, QSP for short. We believe that by buying high quality company that are stable at the right price could win, the market over time with lesser risk. So maybe let me explain what do we mean by that. So high quality company, it essentially means investing in profitable companies that generate a lot of cash in the business. Often, they have a very strong moat around them, right? They have high barrier to entry, and hence it's very hard to dislodge their leadership position. And because they offer some kind of mission critical products and services, so they tend to have pricing power. So in an inflationary environment, they're able to pass off that higher cost to consumers because they are very difficult to substitute away. So that's quality. And for stability, really is buying the steady eddies of the world. They tend to have very predictable earning streams, and you don't see this wide price fluctuation in their stock price, right? And finally, price, right? We wanted to have the price discipline around it so that you avoid the crowded trade. And more importantly, this is to make sure that we don't overinvest or overpay in quality as well as stability.
So I think that is quite aligned with how I typically look at stocks, which is look at the fundamentals, look at the valuation to determine what are some of the better quality stocks to consider. So I guess that is the kind of framework that we are thinking about when looking at the QSP criteria in deciding what stocks go into the portfolio.
Absolutely, yeah.
When we think about this concept around managing volatility, how does the fund actually manage the volatility for investors?
Yeah, so we essentially, again, believe on this QSP approach. It will allow us to manage the volatility. Like I said earlier, we don't have a crystal ball to know what it is going to be like, how market's going to be, but it's also trying to build resiliency into your portfolio to make sure you could weather different scenario, to make sure that you avoid, places that you shouldn't be in and focus on company with this QSP elements.
So sometimes when we introduce this concept of risk-adjusted returns, managing volatility, a question that always comes up is, does it actually use any hedging solutions, derivative products to be able to achieve the outcome?
Yeah.
Is there anything in that concept within the fund?
Yeah, we don't use any derivatives just to, like mitigate the risk. Again, it's just emphasizing on quality, stability, and price. I mean, for our fund, like I said earlier, we believe by having this 90/70 upside downside capture, we're able to deliver very strong equity return, like the MSCI World Index, that's our benchmark. But more importantly, we're able to do it at lower risk or lower volatility.
So in many of our discussion with our readers around mutual funds, the questions asked are often around the yield of the fund, the historical returns of the fund. And I think one question that will inevitably come up is, if the fund is meant to mitigate some of the risk, does it necessarily mean lower potential return?
Well, it's really not uncommon for investors to think lower volatility equals to lower return. Actually, what we aim to do is, with our 90/70 upside downside capture, we hope to deliver a steadier pattern of equity return with lower risk.
Are there any other features around this fund that investors should be aware of?
Well, again, it is focusing on QSP, quality, stability, and price. I think one of the greatest value add of our low volatility is really during crisis moment or during like dramatic market sell-off, right? It's time and again proven that every time when there's this sharp sell-off, we tend to, directionally we'll move like the market. If the market goes down, we will follow the market as well. But I guess the greatest value add, like I said, is that we will go down less.
So using maybe the example from this April and your experience interacting with various clients, so when we saw the global markets having a sell-off as a result of the tariffs, how were some of your clients actually reacting, and how did they actually then use this fund to position their portfolios?
Maybe I can cite my own examples. So in April post-liberation, I took that opportunity to buy into the low volatility equity. And honestly, when I invested, I was very, very worried, right? Because the market had experienced a very sharp sell-off. But during this period, the fund, like I said, directionally moved like the market. It went down, but it actually didn't go down as much or as sharply as the market. And thank God I picked the right time to invest, which is probably one of the lowest point in the month of April. And then I see that eventual recovery, so I get to enjoy that recovery. So it doesn't mean low volatility equals to low return. I think it's about being positioning your company with quality, stability, and price to make sure that you're able to, go through and navigate, such a period.
How did your understanding around a low volatility solution actually help you to navigate the volatility at that point in time?
I guess for this strategy, we aim for a steadier return pattern, right? So you don't see this big swing in our sort of performance. I guess, in rising market, investors are still able to see, them participating on the upside. And more importantly, and that's where, all the emotions comes in, is when markets sell off, that I don't think investors will have to panic that because the fund is tanking so much. I think it's this steady pattern of return that allows them to stay invested for the long haul.
So I think we touched on the concept around loss aversion. The other common investing mistake is actually fear of missing out, or otherwise known as FOMO.
Yeah.
So if I was to then think about the other side, which is then this fear of missing out, how can this solution actually help investors to overcome the fear of missing out as well?
Well, I guess, because of the fear of missing out, people tend to chase trend. They chase maybe like some of the hot stocks. I guess with a strategy like a low volatility, I'm not saying that's a bad thing, but I think with a strategy like a low vol, it's a very good anchor. It's a very good foundational piece that you can put in your portfolio, in your asset allocation, that you can then allocate your resources, and your risk budget onto sort of more thematic, just to take advantage of some of that alpha opportunity. I think it's fine, but I always think that your base should have something like a low vol equity portfolio where it has a more steadier pattern of return. And because it's a portfolio invested globally, it has this element of timeless element to it, that it doesn't go in and out of fashion as quickly as a single stock idea or some hot trend, right? It has the ability to remain evergreen and demonstrate longevity in clients' portfolio. Yeah.
So I think you brought up this concept around having a core within an investor's portfolio.
Mm-hmm.
We should anchor the portfolio and
Mm-hmm.
help the investor to be able to achieve his or her objectives.
Yeah.
When thinking about a volatile market, are there other good practices that involve what an investor can do to achieve his or her objectives?
I'm gonna go back to this timeless principle of investing. I think we all are investing for a goal, right? And it's usually tied to retirement, to making sure that we have enough money as we grow old, or whatever that sort of investment objective or your goals might be. I think it's important to have a plan and stick to that plan. And again, don't let, market trends, don't let this fear of missing out dictate like your investment decision. And I think revisiting that plan routinely is a good practice, and do rebalancing. But also, like I mentioned earlier before, right? Technically, economic cycle, what the market is doing should not derail that long-term plan, and just be disciplined to that.
So that's something that we often share with our readers as well, being disciplined, having a plan. But the question that they always come back to ask
What
is,
should I buy now?
actually, how do I stay disciplined?
Right,
So having
right.
been in the industry for quite a number of years, is there something that helps you to actually achieve your financial goals that you think might be worth sharing with our viewers?
I think it's important to globalize your portfolio. I think it's not uncommon for investors to have home country bias. And what do I mean by that, right? You have a tendency to buy, your companies that are domiciled in your country, or buy Singapore equities or bonds because of the familiarity, because of the comfort. But which is fine, but I think it's always good to have a more diverse opportunity set. So I think it's very, very important to globalize your portfolio. Um, Diversification is very, very important, right? So you definitely don't want to put all your eggs in one basket. Diversify by country, by sectors, by companies, and and I think the way to look at effective diversification is that if you are properly and effectively diversified within your portfolio, there will be always something that will do well and something that will not do well. And it's human nature to try to do something to the parts that are not doing well by selling it out, or by, doing something. But if you are properly diversified, it means that there will be something that's doing well and something that's not, to even out, because everything takes turn, right? So I I think this is very, very important, to really having some of that discipline, having some of that willpower to stay through the course.
So having come a long way in your career as well as your financial journey, and if you were to share a piece of advice to your younger self, what would you say this piece of advice would be?
I definitely learned from my early days mistake, like FOMO is no good, no go to FOMO. In fact, this quote, I stole it from the SEC website in the US. So that was interesting. I thought, wow, that's a good one, no go to FOMO, because I definitely learned that. And I truly believed in globalizing and diversification. I think that's key. And of course, having that discipline. I say this to a lot of my investors, to my clients. Actually, time in the market is more important than market timing, right? I think it's so difficult to market time, and it's just very challenging to get it right. But it's really the time in market that matters. So start investing.
So thanks so much, Karen, for sharing with us today your experience in the capital markets for 25 years, how you think about risk and how investors should be thinking about risk-adjusted returns. when evaluating their portfolios.
Thank you.
So, once again, very pleased to have everyone join us for the Beansprout podcast, where we bring you what really matters to your investment portfolios. Do follow us on our various social media channels, including on YouTube, Instagram, as well as our website, growbeansprout.com. Do join us for our next podcast, where we bring you more investment insights.